Let's, on the flip side, have a look at what are the likely headwinds for the sector. So clearly the interest rates hikes and the subdued exports is what the companies are highlighting. Subdued exports because that is visible on the number front as well. Taking a look at what the company's commentary is looking like, so especially from the likes of Tata Motors, we have got the commentary where they say that the growth is likely to be stronger in the sales ahead for MHCV segment. They are very bullish on the Q4 FY23 sales data. Let's wait by and see, but they are seeing robust recovery in the passenger carrier demand as well, is what the company is highlighting. And Reliance Securities is also expecting that MHCV segment is likely to outperform with 40% of volume growth in FY23. While the overall automobile industry is expected to post a growth of low double digit in FY23, so clearly the CVs are on the road.
CVs are on the road. Let's take the conversation forward. Vinod Aggarwal, Managing Director and CEO. He represents the commercial vehicle business for Eicher. He joins us now. Mr. Aggarwal, good morning. Thank you for joining us.
Good morning. Happy New Year.
Thank you, sir. Same to you. It's indeed turning out to be Happy New Year for Eicher. The numbers are strong, 17% year on year. 47% month on month. October, your number was at 6,000, came down to 5,000, gone up to 7,700. Is there a seasonality at play, or this is the real demand which is now getting reflected?
December, of course, was a bumper month. But of course, the lower demand in November was due to seasonality. So therefore, it's a normal movement as far as month on month is concerned. November was a very good for us as of the industry, and of course it is in line with whatever we had been anticipating, because overall the industry is doing very well, and we are after 3 years of recession, and this is a real year when we are witnessing good recovery in the industry, and we are hopeful that this recovery should last and it should continue for another 1 to 2 years, because still we have to touch the earlier peak of 18-19.
So if I look at the numbers from March to December, the last calendar year, on an average, it's been around 6,500, 6,000 to about 6,500. So can I say that now that you're sounding confident of a CV cycle for 1 or 2 years, on an average for 2023, as of today, you expect that the number would be higher than, in 2023, it will be higher than 2022?
23, we are just going now to 23.
Because of COVID, a lot of replacement demand had got delayed. Do you think
customers have not come back for replacements, and so more and more customers will come back for replacements. Replacements didn't happen in the 2 years of COVID, and then the financiers also were slightly defensive. Now the financiers are upbeat. They are financing very well, and delinquencies are in control. They are not having abnormal delinquencies. They are absolutely normal now, and the interest rates also, even though have gone up, but they have been very well accepted by the market. So therefore, I think based on overall economic activity, replacement and demand, and also more thrust on infrastructure and construction activity, I think the demand for CVs is expected to remain bullish next year.
Mr. Aggarwal, you do sound fairly optimistic going forward, and I wanted to understand, keeping in view the new emission norms kicking in from the 1st of April, how does that impact costs for you in terms of how much of a percentage point will that increase your costs?
Cost increase will happen, but it will not be like earlier BS4 to BS6. So this is a smaller change. There will be cost increase, but not like earlier it happened more than 5% or around 10% in some of the models. This time around, it should be maybe around less than 5%.
It was during the festive period that a lot of these companies offered discounts in order to capture a higher market share. I just want to understand the current discounting trends as well. Have they gotten bigger from the current levels, or are we seeing a reduction?
First of all, we must understand that any industry cannot continue to, give discounts for a longer period of time. I think we had a very, very protracted period when the discounts have been there. There has been a lot of you can say, awareness, lot of realization at the industry level or at all the companies, because it has impacted the bottom lines of everyone. Therefore, I think everyone is very, very conscious that the discounts need to be controlled. So I think there is a good realization, and I'm also expecting that the going forward discounts should come down, because current levels of discounts are not sustainable. If you look at the bottom lines of the CV industry, I think it is really under stress.
Mr. Aggarwal, I understand that exports form a small part of your entire, volume growth. But from last year, where the level was around 800 to 1,000 units per month, it's come down all the way to 300 units. And this is something my colleague was also flagging out as remains as a concern for the entire industry. Do you expect export outlook to pick up in, let's say, at least the second half of the year, if not the first half?
Second half of the year means this last quarter.
2023 H2.
It will be slightly better, because this impact has come because of the global situation and foreign exchange situation of some of the South Asian markets, because of the dollar and the foreign exchange reserves of some of the countries having come down. So they have put a lot of restrictions on imports into their countries. Therefore, exports are definitely impacted. And it is mostly in the South Asian countries like Bangladesh, Nepal, Sri Lanka. And situation in Middle East is better. Situation in some of the African countries is better. But overall, as you mentioned, we have come down from an average of 800 to 1,000 to currently at last month it was just around 300 plus. But we are expecting better situation in last quarter. But definitely currently exports is one of the concern areas.
Yes, so expecting some improvement, but it might be slow and steady. And just before we let you go, Mr. Aggarwal, a quick word as far as the margin and the entire supply chain issues are concerned. How's that panning out with the commodity cool-off? Will margins improve from here on substantially?
I would say we can't conclude that the Bangladesh, Nepal, Sri Lanka, and situation in Middle East is better. Situation in some of the African countries is better. But overall, as you mentioned, we have come down from an average of 800 to 1,000 to currently at last month it was just around 300 plus. But we are expecting better situation in last quarter. But definitely currently exports is one of the concern areas.
Yes, so expecting some improvement, but it might be slow and steady. And just before we let you go, Mr. Aggarwal, a quick word as far as the margin and the entire supply chain issues are concerned. How's that panning out with the commodity cool-off? Will margins improve from here on substantially?
I would say we can't conclude that the margins will improve substantially, but it's a good thing that there will not be more pressure on the price increases, because if you look at the on the inflation properly, when the commodity prices were going, the commodity prices are coming down. We are only, you can say, recovering the price, recovering the cost increase, which we couldn't pass on. Therefore, I don't think you will see major impact on the margins. Margins will get better only once the discounts are come to the more realistic level. As far as the commodity, right now we are not expecting very high inflation. But if you look at previous 2 years, the inflation have been very high, both in 2021 and 21-22. And this year, of course, the inflation is likely to be muted, because we had 2 very bumper years of inflation. And this year, with the commodity pricing cooling down, the inflation is likely to be neutral.
I just want to clear the air here. Demand is strong, and yet you are giving discounts. And there is a margin impact because of high commodity prices. So this is not tying up. If demand is strong, why discounts are there? And if margins are under pressure, why are you giving discounts?
Discounts are there because of the competitive pressures. Because everyone wants to sell more. The capacity is still there. There is capacity available. Everyone wants to increase the numbers, and no one wants to lose the market share. I think discounts are led from that we should retain the market share, and that's why the discounts are high.
That if discounts are taken out, demand could get punctured.
CV demand is directly linked to the economy. The customers also test the waters. They try to find out the best price. They negotiate hard but if the discounts are not there, and if we are not having cutthroat, then of course customers will pay the right price. I'm sure customers, they need trucks. That we can't say that the trucks are not needed by the economy. When the economy is growing, replacements are overdue, and new trucks are more productive. Therefore, the demand will be there because of new trucks. Now it's a question of how the industry is behaving. It's right now it's the need at the individual company levels to maintain the market share, and then to ensure that the companies, there is as you know, in heavy duties there is still a very strong duopoly existing. So that is why the discounts are high.
We leave it at that. Appreciate your time. Thanks so much for joining in and giving us a sense of how things are shaping up. Time for a very quick break, but looks like with Rakesh Arora.